Let's talk about Toronto Dominion Bank, ticker symbol TD. They just dropped a massive Q3 earnings report that literally sent shares flying. I mean, it was a huge quarter. But, it brings us to the million-dollar question, doesn't it? Is this stock rally actually justified, or is the market getting just a little bit ahead of itself? Today, we're going to dig into the numbers, the bull case, the bear case, and the one major regulatory wildcard that could absolutely change the whole shebang.
Okay, let's dive into this explainer and lay out the roadmap. First, we'll hit the catalyst, that Q3 breakout. Then, the bull case, why you might buy. After that, the bear case, looking at the risks. Then we'll check out future milestones. And finally, the bottom line.
So part 1, the catalyst, Q3 earnings breakout. Let's get right into it.
Honestly, you just can't talk about TD's recent quarter without starting right here with this number, $4.62 billion. That is their record net income for the quarter. To put that into perspective for you, it's a massive 38% increase year over year. I mean, think about that. They essentially generated a mid-sized corporation's entire lifetime value in about 90 days. Generating over $4.5 billion in a single quarter? Yeah, that's the primary catalyst driving this recent upward momentum for sure.
And the crazy thing, they didn't just edge past Wall Street's expectations. They completely smashed them. The consensus adjusted EPS estimate was sitting at $2.47. The actual reported number, $2.77. Smashing it by 30 cents like that sends a crystal clear signal. This bank is firing on absolutely all operational cylinders right now.
Now, this momentum, it builds across all three of TD's main business segments. Canadian banking, they delivered record profits, and that was fueled by really strong loan growth. Then you look at U.S. banking, which saw net income rise 12%. And actually, for the first time in several quarters, loan balances turned positive. Bank card balances alone jumped 20%. Finally, wholesale banking profits surged a staggering 76%. But you know what the real icing on the cake is here? Credit provisions actually fell. This is huge because it hints that the absolute worst of the credit cycle might already be in the rearview mirror.
All right, moving on to part 2, the bull case. Why buy today?
So, why would you buy TD today? Well, the first pillar of the bull case is undeniable momentum. Listen to this quote from CEO Raymond Chun. He describes the current environment in Canada as an investment supercycle, and he specifically points to infrastructure, energy, and housing. For us as investors, this matters a lot. It perfectly positions TD as a primary lender to capitalize on these massive macro trends, essentially locking in long-term structural growth.
And that operational momentum translates directly into shareholder value, specifically a current dividend yield sitting right around 4.5%. Let's be real, in almost any market environment, a reliable 4.5% yield from a major financial institution is highly attractive. If you're looking at TD from an income or a dividend growth perspective, this right here is your anchor.
Beyond the dividend, though, TD's capital and valuation metrics are just robust. Their CET1 ratio stands at a highly comfortable 14.3%. That gives them massive firepower. We're talking room for over 13 billion Canadian dollars in share buybacks and dividends through fiscal 2027. And get this, despite the recent run-up, the stock still trades at a pretty reasonable 11 times forward earnings. It's exactly why analysts at RBC and BMO are projecting double-digit upside, with targets reaching as high as 134 Canadian dollars.
Okay, let's flip the script. Part 3, the bear case, flipping the script on risk.
Now, the crucial sticking point here, valuation. While the forward earnings multiple looks totally fine, other metrics are definitely flashing a warning sign. TD's current price-to-sales ratio is 4.4x. That is sitting well above its 5-year average of 3.4x, and it's above the industry median too. Actually, some valuation models suggest the stock could be overvalued by over 50% on a strictly intrinsic basis. If growth slows down even a little or if credit worsens, that premium could unwind incredibly fast.
Then we have the elephant in the room, the biggest regulatory wildcard, the U.S. AML asset cap. Basically, this constraint was placed directly on TD due to anti-money laundering remediation failures, and it essentially caps their ability to expand U.S. operations. Now, to their credit, management optimized their balance sheet to grow core U.S. loans by 3% anyway, which is impressive. But any delays in fixing these compliance issues, that could invite further penalties or even permanently handicap what has historically been a massive profit driver. Finally, we simply cannot ignore the macro headwinds. The threat of a recession in Canada or the U.S. remains very, very real. If the broader economy contracts, it hits commercial and consumer loan demand instantly. And yeah, it would likely drive those credit provisions right back up again. Management is sounding optimistic, sure, but macroeconomic uncertainty is a tangible, hovering threat that we have to factor in.
Which brings us to part 4, future milestones. What to watch next?
So, what does this all mean for the next 6 to 12 months? Well, here are 3 essential things you need to watch closely. Number 1, U.S. AML remediation progress. Any news regarding a resolution, a fine, or an extension of that asset cap, that is going to move the stock significantly. Number 2, loan growth trends. You really want to watch the upcoming quarterly updates on both commercial and consumer lending, particularly to see if that U.S. segment can actually maintain its momentum. And number 3, capital deployment aggressiveness. Basically, how aggressively TD executes those share buybacks is going to be a major signal of management's internal confidence in the stock's current valuation.
And when we look at how Wall Street synthesizes all of this data, we see a really fascinating divergence. The consensus rating is generally a buy, with an average price target sitting around $119. But look closely at the range here. The low target is $98 and the high is $134. Now, Wall Street doesn't always agree, obviously, but a $36 spread between the bears and the bulls? That is massive. This incredibly wide spread proves there is stark disagreement among analysts about TD's true fair value, and it perfectly mirrors that push and pull between the bullish momentum and the regulatory risk we just talked about.
All right, let's wrap this up. Part 5, the bottom line.
So, here's your core takeaway from this explainer. If you believe that the underlying earnings momentum will continue and that the US AML issues will be resolved quickly, then hey, this stock still has plenty of room to run. But if you're feeling cautious about that elevated price-to-sales valuation, or you're worried about a looming recession, waiting for a pullback makes a whole lot of sense. As always, you've got to cross-reference this with your own research or talk to your financial advisor.
Before we go, I want to leave you with a question to really test your own thesis. Weighing those record earnings against the regulatory risks we discussed, are you buying, holding, or selling TD Bank? Let that guide your next move. Thank you so much for joining me for this explainer. Keep learning, keep analyzing, and I'll catch you next time.